What's up traders, Chris Capri here, secondskiesforex.com. So another video for you here. I recently got an email just the other day from a lad named Stuart, and it was a very good email because he covers a lot of different things, and I kind of want to talk about some of these things and why they are important and what you can kind of unearth out of this. So to read the email, he says, "Hi Chris, I've been in the trading game for the last year or so, just slightly short of break even at the moment. I initially went on a 3-day seminar with Trader Support Club, UK based company. After 3 days, I was going to be the next Ed Sekoda, which is kind of funny. The course was well run, and we were given two trading strategies, a momentum break and a momentum pullback. He chose the momentum pullback as the strategy was going to be used as a beginner. The problem was that there were just not enough setups coming my way from the 1 hour time frames and higher. I was also scared to treat breakouts, as most of them are allegedly false, a point we'll get to later. I was frustrated enough and still looked on the internet for other options. Strangely enough, the authority on price action, which is a self-proclaimed title, nobody else has given him that. That's kind of funny. I read through his free stuff, looked at his YouTube, and it looked interesting. Cut a long story short, I bought into his program. I know your thoughts on Mr. Niall Fuller, so I won't say anymore. The irony is I had even less trading opportunities with him than I did with the first course. I have extensively covered your website and trading style. I now use imbalanced non-volatile trends to trade momentum breakouts, 3-touch ascending, descending triangle, EMA 20 squeeze method. I am up 10% ROI in just 10 days. I know it's early trading days still using this method, and I've had a couple of losses. However, my winners have an R to R of 3 to 1, so he's gaining 3 times for every dollar is risked. So if he risks 100 pips, he's gaining 300 pips. If he risks $1,000, he's gaining 3,000. I've read Trading in the Zone and am aware of odds and probabilities, but this just feels right. I'm also aware of risk management, etc. Very strict with that. For me, breakout trading is the way ahead. You know straight away if it's not a real breakout when it moves back into or beyond the range of the ascending descending triangle formation, and then you cut your losses quickly. No hoping in this strategy. I would just like to give you a personal thank you for giving me the insight into the market and how order flow works. No price confirmation and missing half the move. Thank you, Stuart. So there's a lot of great things in this email. First of all, Stuart, thank you very much for this email. I really appreciate it. It's emails like this that just make my day, and so it's just fantastic to get these. Congratulations on making 10% in 10 days. That's excellent work. Definitely a pat on the back there. There's a lot of things that were in this email that were really good, and things that could bring out some important topics that I kind of want to talk about. So the first one is where Stuart mentions he was scared to trade breakouts, and most of them are false, allegedly. So here's the thing about this. That's kind of one of those general statements that really, how can I say, it really doesn't mean much until you qualify what a breakout is. I mean, come on, if you're going to define a breakout as a break above the higher low of any single candle, then dear God, I mean, it's such a loose definition of a breakout that it doesn't really qualify. We at Second Skies Forex, and particularly in the price action course, have a very specific definition of what a breakout. We say there needs to be this element, this element, this element, this element. If these elements X, Y, and Z are here, it totally amplifies it. If they're not, it's no big deal. We qualify a breakout in a very clear way so that you know exactly what a breakout is and what it should look like. On top of it, I've shown many examples, trade examples, live trade videos of me doing breakouts so that students have even a further example of what a breakout should look like. So what the thing about it is that nobody's ever really kind of tested this where they said, okay, I qualify for a breakout with these variables A, B, and C, and when these are present, if the breakout does X type of move, then it's successful, and if it doesn't, then it's unsuccessful. Nobody's ever qualified that. So you have to be kind of understand that it's a very general cliche to say that most breakouts are false. It's really not an accurate statement because we're not properly qualifying how we're defining a breakout. The way we qualify it you end up finding out that actually a lot of breakouts are actually real and very profitable. Sure, it's early days for Stewart, who's up 10% in 10 days, but he's noticing that he's a lot more active. He's finding very clearly and quickly whether these are profitable or not. And that's because he's clearly defined in his mind what a breakout is. According to him, it's a 3-touch ascending descending triangle with a 20 EMA squeeze. So, he's clearly defined it and he's finding success with it. When you clearly define what a breakout is, only then can you truly say, hey, most of these are false or these actually work. I have a lot of students who are just breakout traders and they make money. They've shown me their MyFX book accounts. I've shown you many of them. I will continue to show them year after year of our students making money trading. I have a lot of students who trade breakouts. They make money when you learn how to properly qualify a breakout. So it's very important that we kind of clarify on this point and that you don't kind of fall into the trap of this cliche around breakouts. The second thing is where he talks about how he joined Mr. Fuller's course, and he says, the irony is I even had less trading opportunities with him than I did in the first course. Now, this is a very important concept to understand, which is trading opportunities. So before I get into this, I want to explain something about online poker. So online professional poker players, they know they have an edge, and they're not just playing one table at a time. They're playing on average 3, 4, some of them even 16, 24 tables at one time. Now you have to ask yourself, why is a professional poker player playing 3, 4, up to 24 tables if less is more? The reason being is, first off, less isn't more. The reason being is that if they have an edge over, let's say they are able to get 3, 4, or 5 big blinds over 100 hands. Well, if they can average that, and they know they can kind of consistently over time average that, then the more times they play that edge out, the more profit there is. That's why they play more tables. They play as many tables as they can effectively manage and concentrate on while still maintaining an edge. Why? Because the max amount of tables is the max amount that they can exploit their edge. Now, when you translate this back to trading, what it means is less trading opportunities can and most often will lead to less profit. That has to do with expectancy and trade frequency. And this is a very important thing to understand. So we talk about expectancy, but the basic formula for calculating expectancy. So expectancy is based upon two variables, accuracy and the plus R per trade. The formula is percent winners multiplied times the dollar per winner, and you will subtract that from percent losses times the dollar per loss. That will equal X, and then that is divided by the number of trades. Now I know it's a lot of information there, but I've given you an example here. So let's say you have 100 trades over a year, okay? That comes out to about 8 trades a month on average. If you have a 35% win ratio and you're making $1,000 per trade, you will subtract that value, which is $35,000, from your 65% loss ratio, which is $400 a trade. So this person's getting an average of 2.5 R per trade. Okay? That you take 35,000 minus 26,000, that's your profitability, and over 100 trades you have an expectancy of what is called $90. That's actually a very good positive expectancy. So any positive number will means you have an edge and you're profitable. Now the thing about it is that this is where trade frequency matters. Let's say you're only trading the traditional, I only trade 4 times, 2, 3, 4 times a month kind of thing. Well, guess what? Let's say it's 4. So you're doing 48 trades a year. You got to cut this number in half. That means your entire profitability was just cut in half. Both expectancy and profitability. This is why trade frequency matters. If you have a positive edge with your system, with your strategy, with your method, then you want to multiply that as much as possible through as many trading opportunities as possible. Obviously, you don't want to go outside of your plan, and obviously you don't want to go into a situation where you're trading more trades and managing more trades than you can handle. That's not beneficial to you. It will overload your, it will increase your cognitive load. It'll wear you out. It will affect your concentration. It affects your brain. That's not what I'm saying here. I myself, when I play online poker, I play 4 tables at a time. I would play more, but I can't right now. I don't have the skill set, nor the concentration abilities, nor the, I don't have enough subconscious skills in place to play more tables. Maybe in the future I will. But I'm playing the max amount of tables because I want to multiply my edge by as many tables as possible. The more tables I play, the more times I get to multiply that edge. So this is very, very important because when somebody says, "Hey, I have less trading opportunities with them," they're basically saying that that particular strategy and that particular method that is being taught by the authority offers very little trading opportunities, not enough frequent to really produce anything. And so that is going to heavily affect your profitability. On top of it, this is something I've discussed many times before, which is a concept called feedback loop. So I was recently talking to my poker teacher. I have a professional poker teacher. He's a professional poker pro, and I take lessons from him privately. And he was saying, like, look, Chris, you need to get to 50,000 hands before we can really understand what your baseline is, what your edge is, and everything like that. What he's saying is that you need to get to kind of a in science they call it the gold standard, where they're able to test enough subjects and then they really know how solid that data is. Anything less than that and the data isn't quite as solid. There's a reason why scientists test and test and test and look for as many examples as possible, because the more examples there are, the stronger their data is. Now, if you don't have that many trading opportunities, if you take 4 or 5 trades a month, if you even take 10 trades a month, it's going to take you at least a year before you even have a minimum baseline to work with. That's the first thing, and that's the problem with this. The second thing is that if you're only exercising something 10 times a month, the trade frequency is so low that your feedback loop is really low. A feedback loop is you make a trade, you execute a certain number of things, there's certain processes you do in executing a trade. The market kind of gives you information back to you saying, hey, this really doesn't work, this does work, this doesn't work. That's all feedback, and that process is a feedback loop. The more active your feedback loop is, while being able to maintain a minimum level of concentration, the faster you learn, the faster you grow, and the faster you wire into your brain successful trading habits. It also means that the faster you wire into your brain, greater pattern recognition, your ability to spot really good patterns and trade setups. I myself have spent 50,000 hours behind the charts. I have gone through about 6 different plus pairs over the last 15 years of data. In other words, all the data, all the price action for that particular currency, I've gone through it. I've reviewed it completely from bar by bar, from beginning to end. I've exposed myself to a very large feedback loop. And because of that, I'm able to spot patterns that most likely you are not. It's not because I'm smarter, it's because my brain has a bigger database to work with. And because a lot of these skills are subconscious, my brain is able to just kind of reach in there and say, yeah, I've seen this pattern before. This generally means this. Probability suggests it's going up. Probability suggests this is a breakout. Probability suggests this is going to reverse here. Don't buy into this trend. That's all very important. If you have a very poor feedback loop, you're extending that process out not by months but by years. So what could take my students 3 months, 6 months, 9 months, a year could take you 3, 5, 10 years to get the same kind of feedback to whether you are actually doing the right thing or not. Problem is that most traders who start out do not make it past 6 months, 1, 2, 3 years. The percentage of traders who start out and actually make it past 3 years is very, very low. It's like less than 10%. So if you are trading a strategy and a method that has an incredibly low feedback loop, you're basically saying something that's going to take you 2-3 years before you even have a decent baseline to even know if this works or not. And then at that point, you have to make adjustments. You're going to have to refine things. You're going to have to let some things go. You're going to have to add some things in. Nobody ever gets it right the first time. That is a process. So if it takes you 3 years just to even get to that, and then you have to make more adjustments, and that's going to take a few more years, good luck surviving that. That's most people can't survive that kind of learning curve in terms of time. And so this is super important to understand that you really need to reflect upon in terms of how you trade it in the method that you're studying and the strategy you're using. Okay, a couple more things and that's pretty much it. So he talks about he's up 10% in 10 days. It's a little early. I'd like to see him get 100 plus trades of this before I can even say like, hey, your method's working or not. One thing he said is he's using a 3-touch ascending descending triangle with an EMA 20 squeeze. So when I was at the hedge fund, we had a head of research who was this doctor. He was just a super, super, super brilliant guy. Like, if you need an intellectual to do research and crunch numbers, this was the guy you did. You just locked him away and just said, look into this. And, within a short period of time, he'd have an answer for you. And it would all be backed up by data, and he could show you and, everything you can need to know about it. We actually tested ascending and descending triangles quite frequently, and most triangle patterns tend not to work out that well at all. And we also tested 3-touch ascending and descending triangles. Triangle patterns as a whole were some of the least stable patterns out there. He's adding in an extra qualifier, the 20 May squeeze, which is good, but we trade breakouts a little bit differently. So that's just kind of my message to Stuart, and for those of you that want to learn to trade breakouts, breakouts is a real viable method. So this is very, very important. Anything else that I want to say about that? Not about that. He says, I am aware of odds and probabilities, but this just feels right. So I talked about in the last video the difference between conceptual knowledge and conceptual intellectual knowledge and actual real skill-based knowledge, subconscious skills. So being aware of odds and probabilities doesn't necessarily mean that you can handle variance. Variance is a concept basically saying that, look, if I flip a coin 10,000 times, yes, 50% of the time it should come up heads and tails over that 10,000, flip distribution. But statistically, you can have enough variance to where you can have 7, 8, 9, 10 tails in a row. That can mathematically happen. And so just because you are aware of odds and probabilities doesn't mean you're actually able to handle it. Variance is a skill and a muscle that takes time to wire into your brain. And the more trades you have, the better you are able to manage it, because you're able to, by consistently sticking to your method over time and not being so focused on the short-term results, you're focused on, hey, this is what I need to do, then you're able to handle the swings up and down because you get to see that it'll play itself out over time. I recently restarted my poker training, and so I'm only about 5,000 hands into my new training. And so, I've experienced a little bit of variance, but not much at all. There's some people who can do 5,000 hands in a few days, maybe a week. So, but I noticed that as I keep having more and more and more hands, and I consistently, between 93 and 98% of the time, execute my strategy in poker the way I'm supposed to, I know that I'm building this muscle and able to accept variance. I'm able to just kind of play certain hands out knowing that maybe I do lose this one. Maybe I have pocket aces and I get busted against pocket deuces on the flop or something like that. That's fine. I'm okay with it. It doesn't phase me. Why? Because I understand variance, and I also understand the probabilities that I'm going to win that hand. Out of 100 times, I'm going to win that hand 80+% of the time. So I'm okay with that. It's not just aware of it. I'm actually in that moment. There's no adjustment in my strategy that's, oh, I'm worried about short-term profits. It's no, this is my strategy. This is my method. I keep the discipline. Super, super important that there's a difference between being aware of odds and probabilities and actually having variance as a skill. And then last thing, Stuart says, I'd like to personal thank you for giving me the insight into the market and how order flow works. That's a big thing. We focus on not just teaching candlestick patterns, which isn't price action, that's candlesticks. We teach you price action, and we teach you how to understand the order flow behind it. So as we explain the lessons, we're not just saying, hey, there's this formation, and this formation. We're also saying, look, this is generally what the underlying order flow looks like that would produce this kind of price action. This is what it looks like when this context happens. That's what it looks like when this structure happens. This is So you get people to start thinking and understanding about what kind of order flow would create that kind of price action. And that's a very different mindset. It's completely different. You don't get that from candlesticks, because candlesticks, you're just looking for a few patterns. If they don't happen, I'll wait till the next one comes around. It's a massive amount of candles you're discounting. Candles you shouldn't be discounting. It marginalizes them. And so, it's a completely different approach to that. And the last thing that, even Stewart himself says, no price confirmation and missing half the move. What he's basically saying is that those who teach confirmation price action strategies or price action signals, they cause you to miss so much of the move. This is a student who's saying this. This is a student who's tried several different things, is now trying our method. He's not even a member. He just scoured our website and really studied it. And he's realizing that, hey, I've tried that way and I've tried your way, and I'm realizing with your way, I'm not missing the move. I try the other way. I try and look for confirmation in terms of a candlestick or a price action signal. I'm missing half the move. This is his words, not mine. And that should be telling you something. There's so many moves that you probably missed. If you are a confirmation price action signal trader, if you trade price action signals, these little candlestick pin bars and all these things, you're probably missing more of the move than you really understand. And when you see how my students trade completely differently than that, and they're getting far better entries than you could be taking the exact same pair in the exact same direction, and I'm willing to bet the majority of the time, 70-80% of the time, my students are not only getting a better entry, but that by having a better entry, they're getting greater profitability available to them. There's no student who's traded a pin bar on a daily chart and gotten a plus 40R trade. I have a student. He wasn't trading pin bar. He was trading my price action methods. He got plus 40R on a live trade. You'll never do that with a pin bar. You'll never do that with a fakie or all this BS, patterns. It just won't happen. He made more in that one trade than you probably made in an entire year, maybe 2 years, maybe 3. You can't get that kind of profitability if you're waiting for confirmation and missing half the move. That's not how it works. I'm willing to bet that we can line up all the trades that my students have against all the trades that the students of the authority have taken. Let's match up the ones that are the exact same pair in the exact same direction. And let's compare and see who has the better entries and the higher profitability. I'm willing to bet that we're going to win that matchup 70-80% of the time. That should tell you something. So that's it. That's my video for today. I hope you got something out of this. I hope you learned something about breakouts and confirmation price action signals and trade frequency and why that matters, and expectancy. If your teacher isn't talking about trade frequency and they're not talking about expectancy, then they're teaching you such a basic freshman version of trading that you're missing so much. There's so much that they aren't teaching you. It should be a big question into your mind as to why they aren't teaching that. Because they're not teaching you something that is so fundamental to trading. They're missing something that is so fundamental not only to trading but your profitability. Things that you are not learning that you should be learning, that should just be basic for any trader who wants to take this seriously. These are some things you should be learning. If they're not in there, then that should tell you a lot about what's going on with that person, that how much they're not teaching you. And either it doesn't mean anything to them, or they didn't know it, or they just decided to hide it from you. So you choose which of those scenarios you want. I personally don't care. Either one of them is not a favorable situation for that teacher, that authority, that whatever. So you should really be questioning that. So that's pretty much it. I hope you enjoyed this video. I hope you learned a lot from it. And thank you to Stuart for this email. It's just great getting emails like this, and I get emails like this all the time, but from students, non-students, and it's just even though I get these all the time, every single week, it never the good feeling from it never goes away. So thank you for making my day on that, Stuart. So other than that, I look forward to your comments and questions. If you like the video, give it a thumbs up, share it with people on Twitter, on Facebook, any traders, any forums or anything like that that you participate in, share it. and get it out there. And so, other than that, check us out, secondsguysforex.com. I hope to be working with you. I have a ton of free articles and videos on my site. There's so much there for you. I mean, he was able to make 10% just from looking at my free stuff. Imagine if he was actually paying member like someone this dedicated, what he could do. So I hope to be working with Stuart in the near future, and I hope to be working with you. Other than that, have a wonderful trading week. I look forward to your comments and questions, and I will see you inside the trading world. Take care, everyone.